Dividend investing can do wonders for an investment portfolio. Besides the potential for capital gains, dividend investing provides investors an income stream that can increase over time. So this is an enticing possibility. The question to ask is that how do one find good dividend stocks to invest in? If you ask me, it really boils down to these 5 parameters. Number 1, good financial performance. Number 2, financially healthy and stable. Number 3, sustainable dividend payout. Number 4, good future growth prospects. And finally, number 5, acceptable dividend yield and valuation. With that said, let's get into a little more detail with each aspect. So then the first aspect of good financial performance, simply put, no company can pay out increasing dividends over the long run if they're not doing well in their respective businesses. Thus, the first thing that investors should look at will be the financial performance of a company over the past 5 or 10 years. As the company's revenue and underlying profit grow over the past 5 or 10 years, and with it, as its free cash flow increase in tandem, all these figures can be sourced from the company's income and cash flow statements. A good financial performance over the past 5 or 10 years increases the likelihood that the company can not only continue giving out dividends, but also increase them over time. In addition to good financial performance, it's also important that the company itself is financially healthy and stable. After all, how can investors expect a company to continue giving out dividends if it's not in a good financial shape? To assess a company's financial health, investors can look at company's balance sheet. Some questions to ask is whether the company can fulfill its current liabilities, and also what's the debt profile of the company. Is it too overly leveraged or not? Some useful financial ratios that an investor can use to assess a company's financial health would be the current ratio, quick ratio, debt to tangible asset ratio, and finally debt to equity ratio. So after assessing the financial performance and health of the company, the next thing that investors look at will be the company's dividend payout. Since dividends are cash paid out by a company for business operations, investors should assess if the dividends are sustained by the company's free cash flow. If dividends are comfortably sustained by the company's free cash flow, there's a higher probability that dividends paid out can increase over time. To assess the sustainability of a company's dividends, investors can look at the cash flow statement and divide the dividends paid out by the amount of free cash flow generated. A value greater than 1 means the company's dividends paid out are not fully covered by its free cash flow. Over a prolonged period, this could lead to a decrease or even outright suspension of dividends paid out. However, it should be said that unsustainable dividend payout may not naturally make a company a bad dividend stock, as some companies use debt to fund a portion of their capital expenditure, which can have a direct impact on future cash flows. The key here is for investors to assess if the debt used can positively improve future cash flows, or is simply used to sustain the daily operations of the company. So moving on for the financial numbers of the company, investors should then assess the company's growth prospects. Like, what is the growth prospects of the company's respective sector and industry? Is the company poised to benefit from any industry trends? And also, what are the growth conditions for the company's geographical and revenue segments? By looking at the company's growth prospects, investors can then assess the probability of the company's continued positive performance and whether there is room for dividends to increase over time. Now, we first to admit that this parameter of growth prospects can be a hit or miss at times, as it's easily influenced by macroeconomic and geopolitical factors. Nevertheless, if you invest in a company with a sustainable dividend payout, it does afford you some margin of error should you get the company growth prospects wrong. So maybe the last aspect to consider for dividend stocks would be whether the yield is acceptable and also the valuation of the stock itself. This is crucial for dividend investors, as buying a stock at too high a valuation could severely impact your overall returns over the long run, as dividend stocks do not normally see huge capital gains as compared to growth stocks. Thus, when investing in dividend stocks, investors should always compare the yield to the risk-free rate. By doing so, you can assess the yield premium is proportionate to the risk taken to invest in a particular dividend stock. For instance, if the risk-free rate is 3%, then it might not make sense to invest in a dividend stock that has a yield of 3.2%, since 0.2% yield premium is not commensurate with the risk taken. Of course, this could change the company is in a high growth stage, which is why it's so important for investors to consider the previously mentioned 4 parameters. Besides dividend yield, investors can also use other valuation models such as discounted cash flow or price to earnings ratio to determine if a dividend stock is worth investing in. Personally, for myself, I will consider both dividend yield and forward price to earnings ratio when determining an entry price for dividend stock. So by considering these 5 parameters, I think it provides a solid foundation for building a sustainable long-term dividend portfolio. Nevertheless, do know that you also have to constantly review or dividend peaks to ensure they continue performing with your expectations. If you're interested to find out more about dividend yielding assets, check out my video over here, which is the 8-step guide I use when analyzing REITs.